Hello friends, welcome to UGC CEC Gurukul lecture series. I am Dr. Divya Verma Gakhar, Assistant Professor, University School of Management Studies, Guru Gobind Singh Indraprasth University, Delhi. Today we are going to start with a very interesting topic which is relevant to all of us, that is related to mutual funds. As human beings, all of us are doing an economic activity and we want to earn money, we want to invest our money. So there are various sources in which we can invest our funds. One such source of fund is mutual fund. Mutual fund is a very important tool which is available for a retail investor to see that how he can invest money in the market and also get the benefit of returns from the stock market. So after the saving deposits and the banking instruments which are available, mutual fund is the most sought after source of investment for retail investors. So today we are going to discuss in detail about it. So this lecture series is going for the subject related to financial markets and institutions, so relevant for all commerce and management students at masters and at the graduate level. Apart from that, this lecture will also be relevant for all those people who want to invest money in mutual funds and want to know more about mutual funds. So in this lecture we are going to discuss various aspects of mutual fund, like what are the types, importance, risk associated with mutual fund, net asset values, how mutual funds are organized, systematic investment plans, charges which mutual fund companies are charging, ETFs, gold ETFs, historical background of mutual funds, how one should invest in mutual funds, and some of the top 10 mutual funds we are going to discuss. Now, all of us understand that we all have heard this saying, small drops of water make a big ocean. So this is the basic principle of mutual fund. So basic principle is that this principal amount of the investor remains safe and there is some guaranteed returns to the investor, plus there is some added advantage of capital appreciation to the investor in the form of some interest earned or dividend earned. Now, why do people prefer mutual fund as compared to bank deposit or any other instrument? Because you can invest very small amount of money and can enter into the investment market with the help of this, and you can earn return from mutual funds in a way that without even investing in stock market, with a very little investment you can earn good amount of returns and get all the benefits what capital markets are offering. So mutual fund basically collects saving from various small investors, invest it in government or other corporate securities, and then whatever income is earned on that through interest and dividend, so beside the capital gain, that is collected and it is given back to the investors, the small investor, in the proportion in which they have invested their money in the mutual fund. So basically mutual fund is nothing but a form of collective investment. So it is formed by coming together of large number of investors who invest their surplus funds to a professionally qualified organization who would manage it. To get the surplus funds from investors, the fund adopts simple technique. So each fund, the total amount of fund which is collected, is divided into small fractions known as units. Now each investor is allocated these units in proportion to the size of his investments. Thus every investor, whether he is a big investor or small, he will have some stake in the fund and he can enjoy the benefit of a big portfolio being invested in the capital market. Thus, mutual fund enables millions of small and large investors to participate in the market and get the benefits of the capital market growth. So this has emerged as a popular medium or popular vehicle for creation of wealth due to high returns it offers, it is available at a very low cost, and it also operates on a principle of diversified risk. So we always say that in our investment we should never put all our eggs in one basket. So based on that principle only, the mutual fund company which is collecting small investment from various people, it is investing that money into some diversified portfolio of some government securities, maybe some of the stocks of companies which belong to various sectors, so that the risk of the whole fund is mitigated, and in return we are able to avoid the unsystematic risk attached to any investment, and thus the return of the investor in the mutual fund gets maximized. Now, a mutual fund as defined by Securities and Exchange Board of India Regulations 1993, they define mutual fund as a fund which is established in the form of a trust by a sponsor to raise monies by the trustees through the sale of units to the public under one or more schemes for investing in securities in accordance with these regulations. Another definition related to mutual fund is as defined by Unit Trust in the UK and the open-ended investment companies in US. CAMGO defines an open-end investment company as an organization formed for the investment of funds obtained from individuals and institutional investors who, in exchange for funds, receive shares which can be redeemed at any time at their underlying asset values. Another definition related to mutual fund is defined by Brigham. He says that corporations which accept dollars from savers and then use these dollars to buy stocks, long-term bonds, short-term debt instruments issued by business or government units, these corporation pool funds and thus reduce risk by diversification. So, mutual fund basically are organizations or corporations which pool fund from various investors by selling their own units or share and later on invest that money in some in a portfolio of investment in the capital market, and then are able to reduce the risk by diversification. So, mutual fund is formed when capital is collected from different investors, is invested in the company's shares, stocks or bonds. Now, this is shared by thousands of investors. So, in one fund there will be thousands of investors, and this whole fund will be managed collectively by the fund manager to earn the highest possible returns from the market. So, the person who is driving this investment vehicle is a professional fund manager. Now, what is the difference between fund unit and shares of a company? Just like shares is one proportion of the total capital invested in a company, the price of units of a fund is also quoted in the market. Now, this price is governed basically by the value of the fund underlying investment held by that fund. Investment in equity shares is an individual company, whereas units of a fund represent investment in parts of shares of large number of companies, which comes from diversification. Investment on equity shares can be used by speculators and stock market enthusiasts with a view to gain abnormal profits from the market. But mutual funds are suitable only for genuine investors, as we cannot quickly buy or sell to get abnormal profits from the market. Now, in India, mutual funds have gained momentum only in the year 1980, though it began in the year 1964 with UTI launching its first fund called Unit Scheme 1964. Now, if we talk about mutual fund operations, so investor first he will invest the money in the mutual fund. He gives the mutual fund collects, or the fund manager collects the whole pool of money. He would invest it in some shares of companies or government securities or money market instruments or various other schemes available, and thus he will invest the whole amount of money. After that, these securities, once they are purchased, then returns are generated on those securities. Now, these returns can be returns on FDs, these returns can be dividend declared by companies in some debt instrument if the investment has been made. So, the interest received on those debt instruments, and then it will be passed back to the investor. So, the returns on the mutual fund unit growth. So, that is how the investor in the mutual fund will get the returns. So, these are mutual fund operations. Now, talking about types of mutual fund. Very recently, SEBI has come out with Mutual Fund Regulations 2020. There is a master circular that has come up, and for the purpose of convenience and making the whole system very systematic and bringing more clarity to the whole mutual fund industry, SEBI has identified or classified mutual fund into 5 different schemes. These includes equity schemes, debt schemes, hybrid schemes, solution oriented schemes and other schemes. So, all the mutual funds, different types of mutual funds will now be classified into these categories. Now, based on the traditional classification of mutual funds, we can classify mutual funds on the basis of structures, investment objective and special schemes. Based on the structure, the mutual funds include open-ended funds and closed-ended funds. Based on investment objectives, mutual funds can be classified as equity funds, debt funds, balance funds, money market funds, and under the specific schemes, we have industry specific funds, index schemes and sectoral schemes. Now, let us talk about equity schemes in detail. Now, there are various types of schemes which come under the equity scheme as defined by SEBI in the regulation 2020. So, they have classified mutual funds into equity schemes into multi-cap fund, large cap fund, large and mid cap fund. So, small, as the name suggests, small cap fund means the money will be invested by this particular fund into small capitalization companies. And all of these equity scheme funds are open-ended schemes. Dividend yield fund, value fund, contra fund, focused fund, sectoral funds and ELSS fund. On the basis of execution and operation or on the basis of structure, these schemes can be classified into two types, closed-ended funds and open-ended funds. So, under the closed-ended funds, let us talk about closed-ended funds. Under this scheme, the corpus of the fund and its duration is prefixed. So, closed-ended means that it will have an expiry date, it will have an end date, after which you can't buy or sell that, and till maturity you will not be able to redeem your units. In other words, the corpus of the fund and the number of units are determined in advance. Once, so it is open for subscription. Till the time it reaches the predetermined level of subscription, the entry of investors will be closed after that. And after the expiry of the fixed period, entire corpus is disinvested and whatever proceeds come out as a return is distributed to various unit holders in proportion to their holdings. Thus, fund ceases to be a fund after the final distribution. Some features of these closed-ended funds are that the period and the target amount of the fund is definite and fixed beforehand. Once the period is over and the target is reached, the door is closed for investors. You cannot purchase any more units. And these units are publicly traded through stock exchanges, but there is no repurchase facility by the fund. And main objective for investment in these funds is capital appreciation. The whole fund is available for the entire duration of the scheme and there will be no redemption of demand before the maturity. So, a fund manager can manage the investments efficiently and profitably without necessity of maintaining liquidity. At the time of redemption, entire investment pertaining to the closed-end scheme is liquidated and the proceeds are distributed among unit holders. From the investor's point of view, it may attract a tax because entire capital appreciation is returned at a stage. But the drawback is that if the market is not favorable at the time of getting the returns, you will find that they will not get full benefit of the capital appreciation. Apart from that, generally for the closed-ended schemes, you will find that these are quoted at a discount of up to 40% below the net asset value. Second type of structure-based schemes are open-ended fund. These are also very popular. It is just the opposite of closed-ended fund. In this case, there is no expiry or redemption date which is defined for the scheme. So, anytime you can enter the mutual fund and you can exit yourself from the mutual fund. That means you can buy and sell the mutual fund at any point of time. So, size of the fund and the period of the fund is not predetermined. Investors are free to buy and sell any number of units at any point of time. For example, unit scheme of 1964, so it was a open-ended fund. Some of the features of this open-ended scheme is that investor is assured of the regular income at periodic intervals, and the objective of this type of fund is to declare regular dividend and not capital appreciation. So, basically the pattern of investment in this kind of investment is towards high and fixed income yielding securities, and it is more suitable for those people who are like retired or who do not have a regular source of income, because this may provide some short term gains to the investors. Now, if we classify the schemes on the basis of asset class, so there can be equity funds, very popular ones. These are the funds, they invest in equity shares of companies and they are considered to be high risk funds, but they also tend to provide high returns. So, they include specialty funds like infrastructure, FMCG good funds or banking funds, to name a few. Second type of funds are debt funds. Now, debt funds, as the name suggests, would invest the money, the fund manager would invest the money in the borrowed capital instruments or debentures instrument of companies or government bonds or other fixed income assets. These are considered to be relatively safer investments as compared to equity funds because they provide a fixed return, and these funds do not deduct tax at source. So, if any return is earned, so the investor can pay the taxes himself. Third category of funds are money market funds. Now, money market funds are the funds, they invest money in the liquid instruments like treasury bills, commercial papers, certificate of deposits. So, they are the one who operate or who give the benefit to the retail investors from the money market, because money market generally is not available for the retail investor, which is a short term market with immediate short term maturity market. Now, if somebody wants to earn short term returns on their investment, so the amount of investment will be, the return on the investment will be low, but the risk will also be low. So, they are considered to be safe investments, and those who want to surplus their fund for a moderate period of time for getting some medium returns from the market, then they can invest in money market funds. Another kind of funds are balanced or hybrid funds. Now, balanced funds means it is a balance between equity investment and debt investment. That means the fund manager is going to invest your money in some of the equity share of companies and the borrowed capital instruments available with the government or with the corporates. Now, risk and return in this scheme are balanced out. So, like one example can be Franklin India Balanced Fund. Now, this can, so they would invest 65% in equity and remaining 20 to 35% in the debt market. So, like this they make a balance. Now, based on investment objectives, funds can be classified as growth funds. So, as the name suggests, growth fund. So, that means they are investing money in such securities or such shares where we can see quick capital appreciation. So, that means they will be investing money in the blue chip companies. So, they are considered to be very risky, but they are ideal for those people who want to earn more returns from the market and who are looking at getting higher returns from the market. Another kind of funds are income funds. Now, income fund means, as the name suggests, they would guarantee or they would give income in between. So, they would invest primarily in fixed income securities like bonds, debentures, and also provide some capital protection and regular income to the investors. So, those people who want some regular returns after a certain period of time, so they can invest in income funds. So, liquid funds, as I have already discussed, another name of funds is liquid fund. It is like money market instrument funds which invest in short term maturity instruments like commercial paper and treasury bills. Then there are tax saving funds. So, these are the funds who will provide you a investment in the mutual fund by benefit from the capital market, but will have a lock-in period for the purpose of taxation benefit. So, if you invest money in tax saving funds, you get rebate in the section the Income Tax Act, and you can get deductions under that, and later on, but the money will be blocked for certain years, between 3 to 5 years, and after that you can withdraw the money. So, you will get some extra returns as compared to if you invest in national savings certificates or in PPF or in other, because you will get the benefits of investing in the stock market. Capital protection funds. Now, there can be certain funds which can give you a certain capital protection, that your base capital will be protected. That means these funds are going to majorly invest in fixed income instruments and the equity and some portion in the equity market. So, that major purpose is to safeguard the basic capital or the principal amount of the investors, and later on also try to generate some better returns for the investors. There can be fixed maturity funds. Now, these funds are those where assets are invested in debt and money market instruments, where the maturity date is either the same as of that fund or earlier than that. Another hybrid instrument is called pension funds. Pension funds are those funds that are invested with a really long term goal in mind, and their primarily purpose is to provide regular returns around the time when the investor is ready to retire. Based on speciality, the funds can be classified into sector funds. Now, if there is a fund which invests in some particular sector, for example, infrastructure funds, so they are those funds, fund managers who will invest all of their capital, all of their mutual fund collective money into infrastructure companies. And in case that particular sector is booming in that during that period, so investor can expect very high returns on that. But the risk involved is high, because the diversification, the sector wise diversification has not been possible in this case. Index funds are another kind of instrument. These are those funds who will purchase some index, or they would have some investment in the index of the exchange. So it is like they will replicate the index. They will have the portfolio of all the stocks. Let's say if Nifty 50 index fund is there, so it will try to replicate all the 50 shares of the Nifty in the same proportion in which they exist in the Nifty index. And that means, as an investor, you can expect that portfolio to behave, or that mutual fund index fund to behave or provide you return in the same manner as the stock market index is providing. There can be fund of fund, which means one mutual fund is investing in other mutual funds, and this is how there can be emerging market funds. Now, these funds are those which are in developing countries, they show good prospects, and they are making investment in other developing countries. Similarly, the word international fund suggests that the mutual fund company will invest money in the foreign funds, and global funds are similar to that. Real estate funds are another kind of sectoral funds. There are commodity based stock funds which invest in underlying commodities, and then market neutral funds are there which would invest in treasury bills, ETFs and other market neutral instruments, that means risk free instruments in the market. So, let us have a break.